All right, well, I hope everybody's enjoying doing class from home today. So we're going to cover Chapter 12, and specifically, we're going to focus on segment reporting. The chapter covers a lot of other stuff, but we're just going to focus on the segment reporting. And so what segment reporting is when we have the financial statements put together. They're always consolidated for all the company's operations. However, what GAAP says is, hey, if you have a lot of different segments, then you need to show that in the notes. So you have these huge conglomerates with lots of operations, and we want to so it's going to be helpful to the reader to kind of know a little bit more detail than what we show just in a straight balance sheet or straight income statement. So pull this over. And so what we need to do is we need to go through and we need to identify our operating segments, and then once we've identified them, figure out which ones we need to report. And so when it comes to defining an operating segment, it's really a lot of it's up to the discretion of the company and how the company is structured and what it sees as valuable operating segments. So it's a really vague definition. It's basically, hey, whoever the chief decision maker is, whatever they're looking at to gauge performance, whatever information they're interested in, that's probably going to be the same information that the reader of the financial statements are going to be interested in. And so that can be, if you have a company with different divisions, maybe you define a segment as each one of your divisions. Maybe you have different locations, and so your segment can be on a location basis. Maybe you have different product lines, and so each product line can be a segment. It just whatever makes sense for your business, and so you're gonna have a lot of leeway and discretion on how you want to set that up. So once we've defined what an operating segment is for our business, we want to figure out, hey, what is actually reportable for the business, and so there's going to be a set of tests that we do to figure out what's a reportable segment. And so that's going to be, let's see, let's highlight that. So there's going to be basically three tests that we do. The first is the revenue test. And so if a segment makes up 10% of more of the combined revenue, then we're going to report it. And when we calculate that, so a lot of times segments are going to have these inter-segment transactions, kind of like we talked about earlier with intercompany transactions. So we might have, say we define our segments as locations, and maybe our Nampa facility does sales to our Boise facility. So we're going to count those inter-segment sales when we factor in the total revenue. And if a segment location division has 10% or more of the combined revenue, then we're going to report that separately in the notes to the financials. The other one is profit. If a segment makes up 10% or more of the profit or loss, then we're going to report it. And so when it says profit or loss, what that means is, say we have a company with $1 million in total profit, and say one division has a $200,000 income, so that's going to be 20%, so that's going to be reportable. And then say we have another segment that has a $100,000 loss. Well, that loss, what you would do, you take the absolute value of it. So instead of showing a negative 100,000, you just convert it to a positive 100,000. And that positive 100,000 is 10% of the $1 million profit. So that would be reportable. And then the third test we do is if the total assets for that segment are 10% or more of the combined assets of all of the operating segments. So then if the assets for that segment make up more than 10% or more, then we're going to go ahead and report it. Now, to be a reportable segment, it only has to be pass one of these tests for us to go ahead and report it. And so the other thing that we need to look out for is that when we break out these segments, we want to make sure that what we show as individual reportable segments makes up at least 75% of the total. If it doesn't, then what we would do is, say we add up our reportable segments and it adds up to 65% of the total. And then we have a bunch of these little tiny segments that are just, 1% here, 2% here. What we would do is we would take those smaller segments and aggregate them into, basically redefine them as their own segment. And maybe we add 4 different segments together in order to get that extra 10%. And so then we can get up to that, at least the 75% threshold of the consolidated revenue. The other thing we do is we don't want to have too many segments. So, chances are we don't want to have, close to, 10 or more, segments that we're reporting. That's almost too much information. So what we might want to do is aggregate and combine segments in order to kind of reduce them down. For example, let's use the example where we say a segment is a location. And so say we have facilities all over the U.S. And if we follow our rule here for, the 10% revenue, 10% profit, 10% assets, maybe it comes out to be we have 12 different segments that we need to report. And so then maybe what we do is we change our definition, say, hey, instead of reporting it by, individual location, we're going to lump all our locations by region. So instead of having, maybe we're in 30 different cities, maybe we say, hey, okay, instead of having these 30 different segments by city, we do them by region. So we combine everybody in the Northwest, and maybe there's 4 of those, and we combine them as one segment. Then we do maybe, the Southeast, and so on. So anyway, like I said, we have a lot of flexibility in how to report that, and most of it's kind of going to be, hey, what's going to be the most beneficial to the reader? And so there's a lot of flexibility with how this is done. So okay, so let's go ahead and jump in to our problem. And so for the homework, what we're going to do is we're going to have problem 7 and problem 8 are going to be the homework problems, and we're going to work through problem 8. So what problem 7 does is 7 is going to walk through the steps of determining, hey, what out of all our segments, what's going to be reportable. Problem 8 focuses on, hey, what does that disclosure in the notes look like? And so we're going to hit both sides of it. We're going to focus on 8 for the example, and I think by working through this, it should make problem 7 quite a bit easier as well. So what we have here in problem 8 is we have a corporation, says it's rapidly grown into a very diverse number of different segments. It gives us a trial balance, and so I pull that information over here. It gives us a partial trial balance. This is in the book. Just wanted to note that the book actually has an error. If the book actually shows 20,000 for this, well, I won't pull up the actual problem. Actually, yes, I will. Let's find our problems you guys can see. All right, so we're doing problem 12-8. So it says general administrative expenses 20,000. That is actually not the case. It should be 1,620,000. So no problem. We can work with that. So then it also gives us information on the interest income by segment. It gives us information for the assets, so it gives us the current assets by segment. It gives us the property, plant, and equipment by segment. And it also gives us net sales by segment. And so these are in schedules in the book. I just brought them over into Excel so we can actually use the data and make it a little bit easier to do. So then we have some additional information. It says that 10% of D sales are made to A, 7% of B sales are made to C. The cost of goods sold to A by D is 200,000, and the cost of goods sold to C by B is 144,000. Then it gives us our total cost of goods sold as a percentage by segment, and so I actually moved that down here so we can use these percentages. So of the items that C purchased from B, 25% are still in inventory. So I made a little note right here. So 25% of the items sold by C are still in inventory. So of the G&A expenses, 20% is related to corporate. The balance is allocated proportional to the segment revenues. And let's see, the investment income is traceable to corporate operations. Interest income is shown right here. Included in B's property, plant, and equipment is that B had purchased during the year property for $300,000 that had a value or a cost to A of $250,000, less depreciation of $50,000, so net asset of $200,000. Segment B recorded $30,000 of depreciation. And so it starts us off by saying, assuming that A, D, and B are reportable segments, prepare a disclosure that we would need to put in the notes of the financials. And then part 2, we need to do a reconciliation between the segments and our consolidated. Okay, so in a way, this kind of does us a favor where we don't have to actually go and figure out which are the reportable segments, but just so we know that this makes sense, let's do a quick little check. So let's see. So our 3 tests are 10% of revenues, 10% of profit, 10% of assets. So let's just look at if it makes sense that they say that A, B, and D are the reportable segments. So if we look at the revenue, so the revenues are just going to be, I did kind of shorthand it here. I didn't use the full revenues. I just used the net sales, but we're just trying to do a quick little high-level view just to make sure that what the book's telling us makes sense. So if we use net sales divided by total sales for each one, it looks like A, B, and D pass the test, and C and E are below 10%. Based on the information that they gave us, it would take a little bit more time to work out the profit You'll do that in problem number 7, so I'm going to skip that test. And then in for the assets, so for the assets we have total assets divided for each segment divided by the total, and it looks like A, B, and D as well pass that test. So looks like what the book's telling us as far as what should be reportable makes sense. Okay, so let's jump into the problem here. And so what we want to do is just prepare a note that breaks down the information for each segment as far as what should be reported. So the first thing we want to do is we want to report revenues from external customers. So it gave us, in the information of the problem, it gave us net sales here. Then it told us that 7% of B's sales went to C, and 10% of D's went to A. So based on that information, we can break that down between what's external and what's internal. So A did not sell to another segment, so that's all going to be external, none internal. For B's, 7% is internal, and so the other 93% is external. So part C, they didn't sell to another segment, and then part D, so 90% went to external sales and 10% is internal. So we can go over here to our note, and so we can do A's external sales, B's external sales, and D the external sales. And then all other segments, that's going to be C and E, so we can just add C and E to combine them. Now we want to enter the inner segment sales. So A didn't have any. B, 7% was internal. And D, 10% was internal. And so for all the other segments, they didn't have any. All right, so next we want to add the interest income. And so the interest income, they give it to us up here. So A's is 48,000, B is 10,000, and D is 60,000. And all the other segments are 12,000. So we're going to leave out corporate for this segment reporting. So the next bit of revenue tells us that we have a $100,000 gain on the sale of fixed asset. And so down here in the note, it says that B bought property from A. So A is the one that sold it, so that means A is the one that recognized that intercompany sale. And we're going to show that as a positive number. All right, so now we have the total revenues by segment. All right, so now we need to do the cost of goods sold for each segment. So it tells us all right, so the total cost of goods sold, which the book messed up, is really 1,620,000. Then the book goes on to tell us that, let's see, let's see here. All right, so so the book tells us that cost of goods sold are broken out in the following percentages by segment. So A, cost of goods sold rate is 30%, B is 29%, and so on. So it gives us total cost of goods sold up here of 7,180,000, and 30% of it goes to A, 29% to B, and so on. So we have that calculated here. A, B, D, and then the remainder is C and E. So total cost of goods sold, all right, that matches 7.18, 7.18. All right, then the next expense is general and administrative. And so for the general and administrative, yeah, okay, that's the 1.62. Cost of goods sold the 7.18. All right, so let's see. It tells us that out of the cost of goods sold, 20% is corporate, and the remaining portion is based on the percentage of revenues. So what we need to do is we need to, let's see, say the total G&A times 80%, because 20% is corporate, so 80% is related to the segments. So the total G&A that we need to allocate is 1.296 million. And then it's allocated proportionally based on revenues. So that's going to be the total revenue for segment A divided by the total revenues. And so that's going to be the proportion, multiply it times our SG&A, should give us 371,252 for A. And so we should just be able to drag that across. And hey, that's our 1.296 million that we calculated at first, which is 80% of the total G&A. So that's going to give us our total profit per segment and then total. And then the next thing we need to do is just add in the segment assets, or just disclose them. So the total assets, we have current assets plus property, plant, and equipment. Whoops. All right, now we have the total segment assets as well. And so this is one of the disclosures that we're going to show in the financials. So then part 2 is we want to, GAAP tells us that we need to reconcile our segment numbers versus our consolidated financials. And so the reason we need to do the reconciliation is when we are, as you notice, when we do this, the segment reporting, we're including inter-segment sales and expenses within the report, because that shows the true profitability by each segment. However, just like when we did consolidated financial statements, we remove anything that's intercompany related, because we can't sell from, one division to another and call that sales. That inflates our sales. And so our consolidated financials remove all those intercompany transactions. So the note that it's asking us for is to reconcile the segment versus the consolidated financials. And so we're going to reconcile in 3 different areas. We're going to reconcile the revenues, we're going to reconcile the profit, and then we're going to reconcile the assets. So we'll start by reconciling the revenues. And so we start off by the total revenues from reportable segments. All right, so that is going to be total revenues from our reportable segments. So, right, A, B, and D. Then the total revenues from the all other segments. That's going to be C and E. And then we want to eliminate the inter-segment income. So that, it's going to be right here. We calculated our inter-segment sales right here. Oops. So that's going to be the inter-segment sales, plus we had one more thing that was an intercompany transaction. We had that fixed assets from intercompany sales right here. So we need to remove that as well. I guess the simpler way to do that, let me delete that. We can actually just pull that from these 2 lines. Whoops. There. All right, so basically while we showed 1.45 million for total revenues for segment reporting, our consolidated financials are only going to show 13.6 million. And so this is the reconciliation on how we get there. All right, so the next part we want to reconcile is going to be the profit. And so same idea here, we're the total profit on reportable segments. And so our profit line, so it's going to be these 3 right here. And then the profit from all other segments is going to be the 42,000. Then we want to eliminate our inter-segment income, which we already calculated right here. And then we got to, so that's the intercompany income. Now we want to eliminate the intercompany expenses. And so that's going to be intercompany cost of goods sold and intercompany G&A. And so there's a lot of information up in this problem, so let's kind of break it down into a little schedule to make it just a little bit easier to see. So what it tells us is in our 2 intercompany sales, we had D sold to A and B sold to C. And so out of the cost of goods sold, it tells us got it in two places. So we have cost of goods sold from C to B is 144, and from A to D is 200. That's also noted here and here. So the original cost of goods sold from D to A was 200,000, and from B to C was 144. So that's what D booked and what C booked as cost of goods sold. But then when A sold their portion and C sold their portion, they marked it up and then resold it. So the cost of goods sold that A booked was the same as D's sales. So 618,525. Oops. And then C's markup would be the intercompany sales, because that's the value of their inventory, but it says that they have 25% remaining in inventory, which means they only sold 75% of this. So the 192,430, so we do the 192,430 times 75%. So what we have in our cost of goods sold, which shows up right here, is the 7180. We have total cost of goods sold right here. However, that's part of that's internal, part of it's external. So for what in the transaction when D sold to A, they sold 100% of it. So this was the original amount. This was the marked up amount. That means what we really only want is this 200,000. So that's what was actually sold to external parties, and that was the original amount. That means we're overstated by the 618,000. Now in the B to C transaction, so what was really sold to external parties, so we had an original basis on it of 144. However, we only sold 75% of it, which means the real external sales was only 108,000. That means out of this 288,000, 180,000 was overstated. And you can see that, just the difference between the two. So we have overstated cost of goods sold of 798,000. All right, so the next one is intersegment G&A. And so the intersegment G&A that they're talking about here is depreciation. So we have, so it says Company B recorded $30,000 of depreciation on the machine. And so it's straight line method. So they paid $300,000 for it. They're depreciating $30,000 a year, so you can tell it has a 10-year life. And so, and the overstatement is the original value was the 250 minus 50, so 200,000, and they're depreciating it at 300,000. So they're overvaluing it by 100,000, which is also our gain. And so if we take our gain of 100,000, divide it by the useful life of 10, that means we're overstating depreciation by $10,000 per year. So we need to back out that overstatement of depreciation. The next line is to get to our consolidated profit. We need to include the corporate level revenues. And so the corporate level revenues are going to be, it says that all of the investment income is corporate related, and we also have corporate level interest income of $32,000. So that's going to be our investment income and the interest income. And then we also have our corporate level G&A expenses that we need to deduct. And so that's going to be, we have our total G&A of $1.62 million, and it says that 20% of that is related to corporate. So that means in our segment reporting, we showed profit of $6,086,000, and we're going to reconcile against what the actual financials show of $6,007,000. All right, and then the last reconciliation that we need to do is assets. So we're going to add up the assets of all reportable segments. Going to be right here, and then the assets of other segments, which is right here. We want to eliminate the intercompany assets, and so what that is going to be is we need to eliminate the gain on the assets, plus that extra $10,000 of depreciation, plus we need to eliminate so it says up here that we had 25% of the inventory that was sold between C and B was still in inventory. So that's part of our current assets. We need to eliminate the overstated portion. So the overstated portion of that is going to be 25% of what B shows on, or so I guess what C is going to show on their books, and we only want the difference. Sorry, let me fix my formula here. Minus what it should be, which is the 144,000 times the 25% that's left. Okay, let's talk that one through. So we're eliminating what's going to be overstated as far as the assets goes. So what that is we have B shows an overstatement on their books because they show it at 300,000. It should be 100,000. So that's what this is. But they're also depreciating it by too much, so their accumulated depreciation is too high. So we got to net that out. So too much assets plus too much cumulative depreciation of 10. So that's going to be a net to an overstatement of 90,000. Then we need to correct the inventory that C has on their books, which is overstated. And so as of the total sales, which was 192,000, they had 25% left. And see, that's the total amount they had on the books, but we're okay with showing the true cost of that. We just need to find the overstatement. So the true cost is the 144,000 times the 25%. Gives us an overstatement of assets of 102,108. And then the next little thing we need to do is just add in the corporate assets, which we have over here, corporate total assets of the 1.8 million. And so where we show on our note that total segment assets are 21.5 million, the consolidated balance sheet is going to show 23.3 million. So a lot going on there, but hopefully this is laid out a way where we can kind of work your way through it. So good luck with kind of going through this, and hopefully this will kind of prepare you and set you up to do the other homework problem, which is problem number 7.